Hi everyone, welcome back to Saheb Academy. Today in this fifth video of Internal Reconstruction chapter, we are going to solve our third problem of this chapter, which is a full-fledged question as you can see over here. And this question is from the ICAI study material illustration 3. Okay, so first let's just have a glance of the question, and then what we're going to do is adjustment by adjustment we'll pass the journal entries, and then we'll see the balance sheet, okay, after the reconstruction. Fine. Okay, so see here we have the balance sheet. The balance sheet of A and Company Limited as at 31st March 2022 is as follows. Okay, this is the balance sheet, and then here you can see the notes to accounts. Always have a proper glance of notes to account first. Okay, so this is the share capital, yeah, equity and preference. So definitely we'll be altering something over here and taking the gain to capital reduction account. You all know that. And then see here we have debit balance of profit and loss account, which basically means loss, yeah, accumulated loss. How much is that? 5,35,000. So this is the loss we'll be writing off at the end in that big compound entry using the capital reduction, of course. Yes. And then see here we have 6% debentures secured on the freehold property. Okay, fine. We'll see if there is any adjustment on that, then we'll do that. And then see here other current liabilities, loan from directors. Okay, so loan from directors is what directors have given loan to the company. All right, and the company is supposed to pay to directors, right? So here there will definitely be an adjustment on that, so we'll see that. And then interest payable on 6% debentures. So interest payable on 6% debentures means interest is outstanding to the debenture holders. How much? 22,500. Okay, definitely there will be an adjustment on that, we'll see that. Okay, and then see property, plant and equipment, freehold property, plant, and then intangible asset, goodwill and patents, which we'll definitely write off, yeah, at the end in that compound big entry using the capital reduction. And then see non-current investment, that is investment at cost 55,000. Fine. So this is the entire balance sheet. Now you just have to go to the scheme of reconstruction. See here the court approved a scheme of reorganization to take effect on 1st April 2022, whereby all these things you have to do. Okay, the scheme is already given to you, it's always given to you. You just have to do the accounting of this, give the effect of this, and reconstruct the balance sheet. Yeah, that's what you do. Okay, so many adjustments are there. And then see at last they are saying the requirement of this question: you are requested to show the journal entries reflecting the above transactions, including cash transactions, and prepare the balance sheet of the company after completion of the scheme. Now what does this mean, including cash transactions? It means that certain payments will be made over here, so you have to pass the journal entry of that also, not only the reconstruction but also of that. Okay, everything you have to do basically. It's really simple. Let's just start passing the journal entries one by one by seeing this scheme. Okay, right, let's start the solution now. See here we have the solution. Journal of A and Company Limited. Let's just pass the journal entries one by one by looking at the adjustments. See, the first adjustment that we have over here is the preference shares to be written down to rupees 75 each and equity shares to rupees 2 each. So here they are saying you have to reduce the face value of preference shares as well as equity shares, isn't it? Yes. So how do you reduce the face values? It's really simple. You all know whenever there is reduction in the face value in this chapter, what you have to do is first you have to completely kill off the old capital by debiting it. Yeah, because how do you kill the capital? Capital has, equity has credit balance. To decrease it, you will have to debit. Okay, that's what you will do. And then second thing is you will create the new capital with the new face value, And how do you do that? You will just simply credit that. Okay, let's just see how it will happen. Fine. Let's first talk about the equity shares. Equity shares are being reduced to rupees 2 each. Okay, the face value. So in the question, the face value of equity shares is how much? Rupees 10 each. Fine. So in total 75,000 into 10, that's equal to 7,50,000 capital. So this entire capital we have to completely remove. Yeah, we have to kill it, we have to decrease it. See here, equity share capital account debit 7,50,000, entire capital is being killed off, equity share capital. And then you will create the new equity share capital with the new face value with rupees 2. 75,000 shares into 2. Number of shares are same only, it's just the face value is changing. 75,000 into 2, that's equal to 1,50,000. Simple, easy. Now the balancing figure, right, in the credit, that would be capital reduction. Yeah, whatever difference will come, that will go to capital reduction. The gain, you all know that balancing figure, 7,50,000 minus 1,50,000, that's equal to 6 lakh. 6 lakh will go to capital reduction. Okay, now the same thing you have to do with the preference share capital also. Yeah, preference shares are to be written down to rupees 75 each. Now see in the balance sheet how many preference shares are there? 4,000. Face value is 100. In total, that's how much? 4 lakhs. Yeah, so this old capital completely needs to be killed off because face value is being changed, right? So see, 6% cumulative preference share capital account debit. You have killed the capital, preference share capital. Okay, 4 lakh entirely, and then you will create by crediting the new capital to 6% cumulative preference share capital, 75 face value. What was the number of shares? Number of preference shares? 4,000. So 4,000 into 75, that's equal to 3 lakhs. Simple, easy. Now the difference between these two, 4 lakh minus 3 lakh, that's equal to 1 lakh. Yeah, balancing figure, that will be capital reduction account. The gain will go to capital reduction. Simple as that. Fine. Then next, what do we have? Let's see the second adjustment of the preference share dividends which are in arrears for 4 years. Okay, now understand, here you can be a little bit confused, so go slow and make a diagram. Okay, make a flow chart or something to simplify the sentences. Yeah, if you find it confusing, right? So let's just do that. See here, of the preference share dividends which are in arrears for 4 years. So let's calculate that. Preference share capital in the balance sheet was how much? In the balance sheet, preference share capital was 4 lakh, right? So on 4 lakh, and what is the percentage of dividend? 6%. It's given now 6%, right? So 4 lakh into 0.06, that's 6%, right? So that's equal to 24,000. So 24,000 is the dividend of 1 year, and they are saying 4 years are in arrears, right? So into 4, that's equal to 96,000. Okay, now this sentence is talking about which amount? 96,000 amount. Okay, 96,000 amount. So 96,000, 3/4 to be waived off. Okay, 3/4 of 96. 3/4 of 96,000 is to be waived off. Preference shareholders agree to forego it. We don't have to pay 3/4 of 96,000. How much is that? Into 3 divided by 4, that's equal to 72,000. So we don't have to pay as a company to preference shareholders 72,000 of the dividend. Okay, now this liability was not appearing in the balance sheet. That's why we will not pass any entry regarding this. Completely will ignore this 72,000. But of the remaining one, 1 by 4, yeah, 24,000 remaining, this will have to, pay. But how? They are saying, just see. And equity shares of rupees 2 each to be allotted for the remaining quarter. Quarter means 1 by 4, right? So equity shares of rupees 2 each to be allotted for the remaining quarter. So we have to issue equity shares, new equity shares to the preference shareholders of how much? Of 24,000. Okay, is that clear? So what will be the journal entry? Let's see. It's really simple. See the journal entry over here. But first, see the diagram. Preference share capital were 4 lakh into 6%. 24,000 was the dividend of 1 year into 4. Yeah, 4 years now in arrears. So 96,000. Of this 3/4 waived off. So no entry. I told you the reason. Yeah, it's not appearing in the balance sheet as a liability or something, as a payable or something. That's why, there is no reduction in the actual liability. Fine. Okay. And then here 1 by 4, here we'll have to make a payment in form of equity shares, right? We have to issue equity shares to the preference shareholders, right? Okay, so we have to pass an entry only for this 1/4 portion. What would be the entry? Really simple. Equity shares are being issued, so you have to credit the equity share capital, isn't it? Yes, you have to create the capital. And what will be the debit? The debit will be capital reduction account. Okay, capital reduction account. See here, capital reduction account debit 24,000 to equity share capital account 24,000. Why capital reduction account? Because in this reconstruction scheme, whatever loss we incur, what do we do of that? We debit that to capital reduction account. Yeah, we debit capital reduction account 24,000. Is that clear? And this is a loss to us actually. Okay, fine. Okay, and then let's see the next adjustment. Third one, interest payable on debentures to be paid in cash. Really simple. I told you in the balance sheet we have interest outstanding. See, interest payable on 6% debentures. How much is that? 22,500. Yeah, so you'll just make the payment. How simple is that? But here understand, here they have said in cash. So you have to see in your in the notes to account whether you have cash or not. Yeah, now if you see you don't have cash, right? Do you have cash? Where is it? you don't have cash. See, you don't have cash, but there is a bank overdraft, so you will take bank only. Okay, you will not take cash. So see here, interest payable account debit to bank account. Yeah, really simple entry now. Interest was there as a liability in here, where in other current liabilities. How much? 22,500. So that liability is being extinguished. Yeah, you have to debit that liability and completely finish that off, and payment you are making through the bank account. Okay, to bank account 22,500. Fine. Okay, next entry. Now in the next entry, what they are saying, see here, this you have to understand properly. Okay, it's really simple actually, it just seems a little bit complicated. See here what's happening in this fourth adjustment. Debenture holders agreed to take over freehold property. Okay, they have agreed to take over freehold property, book value 1 lakh at a valuation of 1,20,000 in part repayment of their holdings. So what's happening over here, debenture holders are taking the freehold property to their homes. Yeah, I mean they are taking it off. So our freehold property will reduce, and the debenture holders liability, I mean our liability to debenture holders will also reduce. By how much? By 1,20,000. Understand, by 1,20,000. They have revalued, yeah, they have revalued the freehold property at a 1,20,000 valuation. Fine. So both will reduce by 1,20,000, not by 1 lakh. Understand this. Okay, I mean actually freehold property will increase by 20, and then it will decrease by 1,20,000. Don't worry, I will show you how it will happen. It's really simple. Just understand, it will reduce by 1,20,000 both. Okay, liability is also being reduced by 1,20,000 and asset is also being reduced by 1,20,000. Fine, because 1,20,000 worth of freehold property debenture holders are taking from us. Okay, yeah, that's what is happening. And to provide additional cash of 1,30,000 secured by a floating charge on company's assets at an interest rate of 8% per annum. Now what is this second sentence? To provide additional cash of 1,30,000 secured by floating charge on company's assets at an interest rate of 8% per annum. See, this sentence means that the company is issuing new debentures of 8% to those existing debenture holders. Okay, that's what it means. The company will get 1,30,000 additional cash. Is that clear? That's all it means. So let's see. Two entries you have to pass regarding this. Okay, so let's see. The first is debenture holders have taken our freehold property at the valuation of 1,20,000. So understand, our liability to debenture holders reduced by 1,20,000. Whenever liability reduces, what do? Whenever liability reduces, you debit that. Yeah, you debit that. So 6% debentures account debit 1,20,000. Simple, easy. And then they have taken our freehold property now, our asset now, by at what valuation? At 1,20,000 valuation, right? So to freehold property, this will also reduce by 1,20,000. Okay, actually first we have to revalue, but it's okay, we'll revalue just after this entry. Okay, so see, to freehold property 1,20,000. Is this clear? Really simple, this first entry. Debentures also reduced by 1,20,000 and freehold property also reduced by 1,20,000. And then the second part of this adjustment is they have said that new debentures are being issued. A company is receiving 1,30,000 cash. Okay, so see, bank account debit, we have received 1,30,000 cash, yeah, in the bank, and then we have issued new debentures. Whenever we issue new debentures, what do? We credit the debentures account, right? Bank account debit 1,30,000 to 8% debentures account 1,30,000. Clear? Simple and straightforward. Fine. So we are done with the fourth adjustment. In the first part, what happened? Debenture holders took the freehold property. So because of that, debentures also reduced, freehold property also reduced. And in the second part, new debentures of 8% has been issued. Fine. Okay. Now after this, let's just move on to the next adjustment. Yeah. Next, see, we have fifth, patents and goodwill to be written off, and then 6C, inventory to be written off by 65,000, and then 7th, amount of 68,500 to be provided for bad debts. So all these are writing off, which we'll do at last in the compound entry. Okay, at last in that big entry which we do now, we utilize the capital reduction. Yeah, at that time we'll do. Now we'll skip these three adjustments. Okay, so see here we have the continuing adjustments. See the entries actually. Yeah, 5th, 6th, 7th compound entry at last. Okay, we'll do that at last. Now let's just talk about the 8th entry. See here, remaining freehold property after giving to debenture holders to be revalued at 3,87,500. Now here what's happening? Here the freehold property is being revalued. So how, and you know what we have to do over here? It's really simple. You just have to see how much gain is happening over here. Okay, here also, and that 20,000 revaluation upward also, when the debenture holders had taken, you know, see here 1 lakh to 1 lakh 20, now 20,000 revaluation upward has happened over here. So that gain is there, and here also there is a gain now. So these two gains have to go where? To capital reduction account. Okay, so now we'll take that. It's really simple. Understand how you have to do this. See, the entry is really simple. You know, freehold property is being increased. Yeah, the value is, you know, appreciating. So freehold property account debit, and the gain will go where? To capital reduction account. Yeah, 82,500. But how does this 82,500 came? It's really simple. Understand. First, understand the you know, the composition properly. See here, freehold property in the balance sheet was how much? 4,25,000. Okay, how much? 4,25,000. So see here, book value, the total freehold properties value is 4,25,000. Now, what happened before this? Debenture holders have taken 1 lakh cost of, you know, freehold property at a valuation of 1,20,000. Yeah, 1 lakh was the cost. They have taken it at 1,20,000. So 20,000 upward revaluation has happened over there, right? See here, 1 lakh is the book value, and that revalued figure was 1,20,000. So 20,000 revaluation upward has happened, and then after this event, they said that remaining, what is the remaining? Remaining is 3,25,000. This has increased to 3,87,500. Yeah, that is what they are saying. See, understand properly. First what happened? First, 1 lakh worth of property was taken away by the debenture holders at a valued amount of 1,20,000. So 20,000 extra valuation happened, right? Revaluation upward. And then they are saying in this 8th adjustment, remaining freehold property after giving to debenture holders to be revalued at 3,87,500. They are saying remaining freehold property. What does remaining freehold property means? Remaining means this 3,25,000. You have to understand this. It's logical. 4,25,000 was the total amount. 1 lakh was taken away, right? Book value I'm talking about. 1 lakh was taken away. The remaining is 3,25,000. So this has been revalued upwards to 3,87,500. So what's the revaluation upward? The difference between these two, right? So that's 62,500. Let's just calculate. See here, 3,87,500 minus 3,25,000. Yeah, I'm talking about remaining, remaining freehold property. So that's equal to 62,500 revaluation upward. So in total, how much profit is there? How much revaluation gain is there? 20 in the beginning, and now 62,500. So that's total 82,500 gain is there. Now this gain has to go where? To capital reduction. Yeah, that's what we do now. In this scheme of reconstruction, in this chapter, whenever there is a loss, we debit capital reduction. Whenever there is a gain, we credit capital reduction, right? So that's what we are going to do. See here, freehold property account debit to capital reduction account, 82,500, 82,500. Simple as that. Freehold property increased by 82,500, and the gain went to capital reduction account. Fine, simple as that. I hope you have understood. It's really simple. Okay, fine. Next adjustment is, see here, 9th adjustment, investment be sold for 1,40,000. Now this is very simple. Of course, you know this entry. Investment is there over here. It's 55,000. The cost of the investment is 55,000. It is being sold for 1,40,000. So how much, you know, gain is there? How much profit on sale is there? 140 minus 55. That's equal to 85,000. So this 85,000 will go where? Capital reduction. Yeah, that's what you have to do. See here, bank account debit 1,40,000. Yeah, you have received, the company has received 1,40,000 money in the bank account, and you will credit the investment with the book value, whatever there is there in the balance sheet. That's 55,000. Yeah, 55,000, isn't it? Yes. And then you will take the gain, the profit, to capital reduction account. Yeah, balancing figure also you can write 85,000. Yeah, 85,000. Clear? Easy. Next adjustment is, see here, directors to accept settlement of their loans as to 90% thereof by allotment of equity shares of ₹2 each, and as to 5% in cash, and balance 5% being waived. Now understand, this director's loan, it is entirely appearing in the balance sheet as a liability. Yeah, other current liabilities, loan from directors 1 lakh, which means as a company we have to pay 1 lakh to directors. So this entire 1 lakh is the liability. So of this 1 lakh, what's happening? Understand, of this 1 lakh, 90% is what? 90%, yeah, 90% thereof by allotment of equity shares. We are, giving equity shares for the 90%. So that's 90,000. Yeah. So 90,000 worth of equity shares we have to give to directors. Fine. And then remaining 5% will be paid in cash, which is 5,000. Yeah. 5% of 1 lakh, 5,000, which will be paid in cash. And remaining 5% is the gain for us. Yeah. Because directors have foregone the remaining 5%. Yeah. 5,000 will go to capital reduction, the gain on this. Fine. So let's just see the journal entry. It's really simple. See the journal entry over here. Directors loan account debit, entire liability is being closed. Yeah, 1 lakh. Okay, it's killed. And then you will create the capital to equity share capital. How much? 90% of 1 lakh. That's 90,000. Clear? And then you will pay 5%, which is 5,000 to bank account. And then at last 5% you will not pay. It is foregone, right? It's being waived off. So that will be a gain for you to capital reduction account 5,000. Clear? Simple as that. And then we have the big club entry, the compound entry. So how will you pass this? It's really simple. What you have to do is you just have to see properly what all things are there. At last, okay, one more thing is there. See this 11th one. There were capital commitments totaling 2,50,000. Now understand, this is a contingent liability. Okay. Yeah, this is a contingent liability. These contracts are to be cancelled on payment of 5% of the contract price as a penalty. Yeah, so we are cancelling the contracts, and because of that we'll have to pay 5% as the penalty, right? So only that 5% will record over here as a loss. That's all, nothing else. Okay, because this is not a liability, it's a contingent liability. Yeah, here it's not appearing as a liability or something. So that's why, only 5% that which we have to pay right now, only that we will record over here as a loss. Fine. So 5% of what? 5% of 2,50,000. 2,50,000 into 0.05, that's equal to 12,500. Okay, fine. So we'll do that in the club entry only. See here, capital reduction account debit. Okay, first this amount will be blank over here. Okay, leave that. Take here 2 patents. How much? 37,500. You can get that in the balance sheet. See here in the balance sheet, patents are there. How much? 37,500. And then goodwill 1,30,000. Okay, 1,30,000. And then inventory, they have said you have to write off the inventory by 65,000. Inventory to be written off by 65,000. So inventory 65,000. They have said buy. Okay, not to. They have said buy. So see in the question, the inventories are how much? Yeah, here it is, 4,25,000. Yeah, inventory is 4,25,000. So you have to write off the inventory by 65,000. So to inventory 65,000. And then they have said amount of 68,500 to be provided for bad debt. So you will have to create a provision for that. Okay, to provision for doubtful debts 68,500. How do you create the provision? You credit that, isn't it? Yes. And then that payment also you have to do now. I said this one, the contingent liability one, 5%. Yeah, 5% of 2,50,000, that was equal to how much? 12,500. So to bank 12,500. Yeah, it's a loss now. It's a loss for you. So it will be given out of capital reduction. Okay, it's a loss. And then to profit and loss account. Now understand, here at last there is a loss also now. Debit balance of profit and loss. Yeah, which is a loss, 5,35,000, the accumulated loss. Maybe it's of 2 years or 3 years. So this loss you will have to what? You will have to write it off over here, 5,35,000. Is that clear? So now after taking all this, now what you have to do? You have to check in the question, check all the journal entries wherever there are capital reduction name is coming. Yeah, see here, first here there is a capital reduction. Yes, so let's just calculate how much balance is there in capital reduction. We need to know that, right? See, 2 options you have. Either you can just calculate in the calculator, or you can create a T account of capital reduction and find out how much balance is there in capital reduction account. Okay, that's also fine. So let's just do this calculator way. It's really simple. Here capital reduction is credited. Credited means plus over here for capital reduction. Okay, so 6 lakh plus, then capital reduction again here it is credited by 1 lakh, so plus 1 lakh, and then capital reduction is debited over here 24,000, which means minus, so minus 24,000, yeah, minus 24,000, and then again yeah, nothing. Now see here in the 8th entry here capital reduction is being credited, so plus how much, 82,500. Okay, and then here again in the 9th entry capital reduction is being credited by 85,000, so plus 85,000, and then here capital reduction is being credited by 5,000 in the 10th entry, right? So plus 5,000. So now you will get the balance, whatever balance that is there in the capital reduction account, which is equal to 8,48,500. Yeah, 8,48,500. Now what you have to do, you have to go on subtracting all these, right? 8,48,500 minus 37,500. Yeah, the amount you have to utilize to write off the patents, and then for goodwill 1,30,000, and then for inventory 65,000, and then for provision for doubtful debt 68,500. Yeah, and then for this payment 12,500. Yeah, that's also loss, right? And then to write off this profit and loss balance, yeah, debit balance, which is a loss, minus 5,35,000. So now what's happening? 0. So you see, this is the question where capital reduction and all this utilization is equal. Yeah, in this question at last there is no balance left in capital reduction account. This 8,48,500 is completely being utilized to write off all these things. Yeah, is that clear? Right, so this is the most optimum, what you say, reconstruction. Entire balance of capital reduction is being utilized properly to the best what do you say, the best choice actually. Yeah, okay, so these were the journal entries that you had to pass in this question. Now let's just move on and see the balance sheet. Okay, it's really simple. Now let's just see how to prepare the balance sheet after the reconstruction. It's really simple. The first thing that you have to do is you have to completely be clear with the format, okay, and then see the question properly, the existing balance sheet, the old balance sheet, okay, and then by looking at that you just have to see properly what all journal entries you have passed. Yeah, so what all the effects are there because of these journal entries, and then give that effect in the new balance sheet, right? So let's see. It's really simple. First, see, balance sheet of A and Company Limited, in the bracket you have to write and reduced. Okay, half mark is there for this now, as at 1st April 2022. Fine. Equity and liabilities, shareholder funds, share capital. In share capital, what do you have? If you see, you have equity share capital and preference share capital, right? Notes to accounts I'm talking about. So first let's just talk about equity share capital. What did we do with equity share capital? See, in the question equity share capital was 7,50,000. Yeah, 7,50,000. What did you do over here? You reduce the face value. Yeah, just look at the journal entries. In the journal entries, if you see, you know that you have completely finished off that capital 7,50,000 and you have created new capital of how much? 1,50,000. So now can you take this 1,50,000 directly over there? No, 1,50,000, and then you also have issued some more equity shares, right? Here also for the dividends, right? You have given equity share capital, equity shares to the preference shareholders of how much? 24,000. So 1,50,000 plus 24,000, and then again you have given equity shares to directors, right? See here, equity share capital 90,000. So all this you have to add, all these three. 1,50,000 plus 24,000 plus 90,000, that's equal to 2,64,000. See here, 150 plus 24,000 plus 90,000, that's equal to 2,64,000. Is that clear? And then preference share capital. So what you have done to preference share capital, see in the question. Preference share capital were 4 lakh. What happened to that? In the scheme of reconstruction, you have reduced the face value to rupees 75, and only that exists now, 3 lakh. Yeah, and nothing else. You have not issued any new preference share capital for anyone. Okay, just 3 lakh, this only. So directly you will take that. Okay, 3 lakh. Is that clear? Simple as that. Okay, so 3 lakh plus 2,64,000, that's equal to 5,64,000. Fine. So share capital is over. And then you have non-current liabilities, long-term borrowings. So note number 2, what's happening? Let's see. It's really simple. You have debentures, right? Long-term borrowing, secured debentures. So first is 6% debentures, which were there previously also. See here, 6% debentures. How much? 3,75,000. What happened to that? What did you do to the debentures? It's really simple. In the scheme of reconstruction, what happened was debentures were reduced by 1,20,000. Why? Because they took the freehold property of 1 lakh book value at a revalued amount of 1,20,000. Yes, so debentures were reduced by how much? By 1,20,000, isn't it? Debentures are debited by 1,20,000, which means debentures are being reduced, have been reduced by 1,20,000. So simply what you will do is 3,75,000 old balance minus 1,20,000, that's equal to 2,55,000. Yeah, 3,75,000 old balance of 6% debentures minus 1,20,000, the reduction which has happened, so that's equal to 2,55,000. Is that clear? Simple. 2,55,000. And then we have issued new debentures also of 8%. Yeah, and we received 1,30,000, isn't it? See here, bank account debit to 8% debentures, 1,30,000, 1,30,000. So this also you have to account over here. 8% debentures, 1,30,000. So 255 plus 1,30,000, that's equal to 3,85,000. So if you see in the balance sheet, long-term borrowings 3,85,000. Simple, easy. Next you have current liabilities, trade payables. How is it 3 lakhs? It's really simple. See here what happened. Trade payables. In trade payables, what was there? Nothing, right? In the old question, there was 3 lakhs. Yeah. Now also it's 3 lakhs. Yeah, there is no difference at all because there was no any adjustment regarding that. So it's same only. Fine. So it's same only. Trade payables is same only. Okay. So there is no note in that. Nothing. Just move on. Assets. Non-current asset, property, plant and equipment. Note number 3. So in property, plant and equipment, you have done reduction, revaluation and everything. Okay. Let's see what has happened. Freehold property. Previously, freehold property was just 4,25,000 and there was plant of 50,000. This is the question, right? Freehold property 4,25,000 and plant 50,000. That's all that was there. Now what happened? Because of reconstruction, in the internal reconstruction, you have revalued the freehold property. Yeah. In total, we know the revaluation was how much? The total revaluation upward was how much? 82,500. This much appreciation happened, isn't it? See the journal entry. Freehold property account debit 82,500. So freehold property increased by how much? By 82,500. So you have to give this effect now in the balance sheet. Freehold property add appreciation under the scheme of reconstruction 82,500. Clear? And then what happened? Debenture holders, took away 1,20,000 worth of freehold property at the revalued amount. I'm talking about 1 lakh was the book value, but the revalued was 1,20,000. Now see, revaluation happened over here, so you can less 1,20,000. Okay, so minus 1,20,000, so that's equal to 3,87,500. 3,87,500. Is that clear? It is simple now. Old balance was 4,25,000. Total revaluation upward was 82,500. We know that. And then 120 debenture holders took away. So the remaining is how much? 3,87,500. And then there is also plant also now 50,000. So in total that is equal to now 4,37,500. Clear? Easy. So you see in PPE here, see note number 3, 4,37,500. Okay. And then no intangible assets. Okay. So no intangible assets, as you can see over here. Goodwill is being written off. Yeah, and patent is also written off, right? There is no goodwill, there is no patents. Written off under the scheme of reconstruction, written off under the scheme of reconstruction. Nil nil. Clear? Easy. And then at last, what do you have? And then at last you have see the balance sheet of the solution. The balance sheet of the solution, you have the inventories. Now you know what happened in inventories. Yeah, there was just a reduction. Yeah, what was the reduction? 65,000. So previously inventories were how much in the question? 4,25,000. So 4,25,000, see 4,25,000 minus 65,000. The question told us now that we have to reduce the inventory by 65,000. So that's equal to 3,60,000. So the new inventories will be 3,60,000. Shall I write over here? You will not write over here actually, okay? I'm just writing just to let you know. 65,000. Fine. Okay. And then trade receivables. In trade receivable, what happened? Note number 5. You all know we have created a provision over there, right? see here, we have created a provision of how much? Of 68,500. So what we have to do, we have to show it, display it in the notes to account properly as a deduction from the trade receivables, right? See here, trade receivables less provision for doubtful debts, 68,500. 4,85,000 minus 68,500, that's equal to 4,16,500. Okay, so this is the trade receivables figure, 4,16,500. And then cash and cash equivalents, I will tell you how this calculation has been done. Okay, but understand one more thing is missing from over here. What's that thing? See, we have sold off the investment, so this has been removed, right? It's no longer there in the balance sheet. Investments are no longer there. Yeah, otherwise there were investment, non-current investments, but now there are no investments. Fine. Okay, after this, what else? Cash, right? How did they get cash figure? And see, bank overdraft is also not there, huh? Why bank overdraft is also not there? Just see, there is now positive balance in the bank. See what happened? See the journal entries properly. If you see the journal entries, see, just take the calculator. First, there was bank overdraft of how much? 1,95,000 negative. Yeah, bank overdraft means negative figure, it will be shown in the liabilities. But now see, minus 195 is there. Okay, already minus 195 there. So now let's see what's happening. In the first entry, is there any bank? No. In the third entry, there is bank. How much? Bank 22,500. So because of this, your bank overdraft increased by 22,500. Okay, so that's equal to 2,17,500. And then what happened? You received 1,30,000 from the new debentures, which you issued, 8% debentures, 1,30,000. So plus 1,30,000, that's equal to minus 87,500, still negative. Let's just see in the following entries what's happening. And then here bank, no. And then in 9 in 3, we have received money of how much? 1,40,000 by selling of the investments, right? So plus 1,40,000, that's equal to 52,500. And then what happened? Let's see. And then we had to make payment to the directors for the loan, right? 5%, that was 5,000. So minus 5,000. Okay, so that's 47,500. And then what happened? And then because of that contingent liability, that that commitment which we cancelled, that contract, because of that we had to pay the penalty of how much? 12,500, which was a loss. But yes, we had paid, right? So bank has been reduced because of that, bank balance. So minus 12,500. So that's equal to 35,000. You see, this is the ending balance of the bank. From the overdraft, it has been converted into positive bank balance. Okay, so that is what has come over here, 35,000. Okay, is that clear? So this is how you have to do it. Either you can create a simple cash account, the bank account, or you can just do the calculation in the calculator. Fine, you will find out what is the new figure in the bank. Is that clear? The balancing figure. Fine. So that's all for this video. I think you have understood. It's really simple. Yeah, you have understood. Now in the next question, we'll solve one more full-fledged problem, which will help you to understand everything. Okay, the consolidation, the subdivision, and everything, and more adjustments. Okay, fine. So that's all for this video. If you have any doubts in this and all, please comment down below, or you can also message me in Instagram. I will try to clear it as soon as possible. Okay, is that clear? All right, bye. See you in the next video.